Let's bring in Achuthan from the Economic Cycle Research Institute. Thank you very much for being here, Lakshman.
Thanks.
I was reading the producer's notes, you have more of a contrarian take on where we are in the economic cycle right now. You don't agree with what Williams was just saying?
Oh, respectfully, no, I don't. And my ears did really perk up when he said positive signs in terms of where we are in the economic cycle, because, of course, we're at the Economic Cycle Research Institute, and we have a completely different view. In fact, growth, cyclically, has been slowing since last spring, and, it is not over. That slowdown is not over. And so the Fed, right, so they've kind of woken up after Thanksgiving, whatever happened, and they woke up to the fact that inflation isn't transitory. They're so far behind the curve, they've got to play catch up, but they have to put a positive spin on it. So I understand what President Williams is trying to do there, but the fact remains that the Fed risks making a serious policy mistake, tapering and tightening into the teeth of a sustained cyclical slowdown. The slowdown's not over.
I just want to back up for a second here. What data points are you looking at that indicate that the economy is slowing right now? And why do you think that these are not the same data points that Fed officials are looking at?
Right. So when you're looking at the economic cycle, you're looking at output and employment and income and sales, and those define the economy outside our window. We have a lot of volatility around the COVID recession and recovery. And so you have these, record-breaking kind of growth numbers to the downside and to the upside. And now we're slowing down. And so we've been coming off of these peaks. I think people were very surprised, to tell you the truth, about how weak Q3 was. The headlines very much tried to pin it all on Delta, but it's really it's part of a cyclical decline that began last spring. And now that is going to continue. We'll have a bit of a bounce in GDP numbers, for example, in Q4 versus Q3. But the economy, the economic cycle is output, employment, income, and sales. And when you look at those hard data, they are slowing. You can put them into different kinds of coincident indexes, which we do to date where we are in the cycle. We're very clearly in a growth rate cycle downturn. So take jobs, for example. Sure, if you lose several million, many millions of people out of the job market, the unemployment rate is going to go down. Okay, that's not a mystery. But when you look at jobs growth, what is going on with non-farm payroll jobs growth? You see it's been declining for 7 months straight. And when you take a look at income, taking transfer payments out of it, growth in real personal income has been going down for 6 months straight. Those are coincident indicators of how the economy is doing. We're in a slowdown. You can take that to the bank. That's definitely happening.